name's Angel. I'm one of the co-founders of Virtuous Benefits, and this is my counterpart, Neer Patel. I'll get started as he kind of sets that up. So if this is your first conference, or if you come every year, no doubt you've noticed that the DPC movement is growing, and really there's nothing that's going to stop it. You're also noticing that employers are taking notice. Some are already reaching out to DPCs. Some DPCs are already working with them. That's going to increase over time as well. And so our presentation today is, as you're kind of getting these new opportunities and you're explaining to potential employers why it's important and some of the new tools that are available, we're going to take the first part of our presentation to help you and help the employers understand how their current insurance works, because once you start telling about the new tools that are available, they're going to say, I don't even understand how Blue Cross makes money or how it all works. You're going to confuse them. So we're going to take the first part of that to give you some pointers on what to talk about. Demystifying employer healthcare insurance for DPCs. That's our goal. A little bit about myself. So I've been in the industry for about 15 years. Feel free to read the bio. But what I have seen in my career is that when a company invests in their employees to have a comprehensive benefit plan, the company thrives. Because if you invest in your people, they're going to work hard for you as well, and your company's success is going to thrive. So I have seen that happen year over year, and with DPC and some of the plans we'll talk about, that only magnifies even more.
Hi, everybody. I'm Neer Patel. I think many of you know me, but I see a lot of new faces in the room, so that's super exciting. So this is my family, Katrina Iqbal, and then our two kids, Ari and Kian. They're 7 and 8. They're the reason why we do everything that we do. My wife is a family physician, just like many of you. And 9 years ago, after a couple of years of working urgent care, after finishing residency, she came home from work and said, I'd like to quit medicine. I don't want to be a physician anymore. And I think all of you know the reason why she said that. And so that was kind of the time we decided we have to figure out a different way, and learned about DPC from a friend of ours who had just opened his DPC practice about 6 months prior in Austin, Texas. And we just kind of took a leap of faith. She quit her job, and we opened Direct Med DPC in Austin with one tiny room and 0 patients that we started in February of 2015. So this is our practice. We have grown it since then now to 7 physicians and 4 locations across Central Texas. So we have Austin, Texas, Lakeway, which is a suburb of Austin, and then a couple of towns in between Austin and San Antonio. We have an office in New Braunfels and an office in San Marcos. And these are our amazing physicians that all work with us. Susie Lessing, Shirley Metz, Katie Keller, Beth Just, Janelle Sosa, and Travis Simmons. We have never put out an ad for a physician. We advocate for DPC as much as we possibly can. We do a lot of podcasts, we do a lot of social media and things like that. And so a lot of these physicians, well, all of these physicians have come to us kind of out of the woodworks. They've seen us on different social media things that we've done. They've seen our website, and they just kind of reach out and they're like, I'm miserable in the traditional system. I love what you guys are doing. Do you have a place for us? And we basically talk to anybody that comes in, that wants to potentially come to DPC or even learn about DPC, whether they want to work for us or not. And we help educate them. And then if they're the right fit and, basically a genuine person that wants to really provide high quality care to their patients, then we kind of talk to them about where are you located, are you looking to be employed, and let's build the office around you. And that's kind of how we've grown our practice thus far.
So how does traditional health insurance work? And we're specifically talking about 2 things, fully insured and network plans. Again, you ask the average consumer that has Blue Cross, they say, I don't know how Blue Cross works. I have my card, I show up, I give my copay, and that's that, right? That's all they know. And it goes up every year. So the first thing we're going to understand is, what does the term fully insured mean? And so basically at its core, it's just a fixed premium that covers employees' medical expenses, right? Pay your premiums, don't ask any questions of where the money goes or how it's spent. You get access to all these doctors. That's essentially what fully insured is. The other thing that I wanted to talk about was, how do they come up with the number, right? Because it keeps going up, and you might be thinking, well, do they just make it up? How is it this expensive every time? Now, it depends on the size of employer that you have. So if you're under 50 employees, they get 4 points of data from you and your employees. Everybody's name, date of birth, zip code, and gender. And they base the rate based off of those 4 points. Now, think about that when you know about insurance, and that insurance at its core is just passing risk from one entity to another. So with those 4 points of information, they don't know if somebody's 50 years old and healthy, or 50 years old, 1 foot in the grave, the other on a banana peel, right? So do you think they're going to overcharge you or undercharge you? Every single time they're going to overcharge you, right? Because that's their model. Now, when you're over 50 employees, they'll get the same information, but on top of that, they'll look at claims history, your renewals from last year, just to, again, assess the risk. But the claims data, as you've been finding out through this conference, it's actually overinflated, and we'll talk a little bit more about that why. Now, network. Everybody, again, knows the big carriers. BUCA is the acronym that everybody uses, Blue Cross, Cigna, Aetna. And so when you think about what their sales pitch is, it's always, hey, you have access to this big network, right? Are your employees in different states? Perfect. We have providers in those states. Do you want to give your employees a choice or tell them where to go? No, I want to tell them that they have a choice. Perfect. We have a PPO plan for you. That's the sales pitch. But what they don't tell you is what those contracts actually say, right? How many of you either have been or are willing to go on a blind date? Not many, right? Fun fact, in college, Josh Umber only had blind dates. That's the only way he could get it. I can say that. We had bourbon last night. We connected. But you're signing blind contracts, right? That's the part they don't tell you. And they don't tell you how much things cost. Because, again, like a little magician, they're saying, look over here, and not showing you what they're doing, that sleight of hand. So that's what network insurance is, right? They tell you one, but they don't tell you what's going on behind the scenes.
So we might wonder when we have a health plan, not every year is a bad year, right? There's years where people don't get sick, they don't go to the hospital, they don't have major surgeries. So who keeps the money in those bad years, right? We're still paying the same amount of premium, and actually, in fact, we're paying more premium every year. So when a company has a good year, who keeps the money? The answer is the carriers keep the money, and they distribute it between their executives and their shareholders. They don't provide us any credit on the good years for the bad years to help offset things. They just keep all the money. And then we also want to understand, when you're an employer, whoever is advising you and helping you assemble your health plan, you want to understand how they're compensated. Anytime anyone's advising you on anything, you need to understand how they're being compensated to make sure that their incentives are aligned with yours. In the traditional system, brokers are essentially compensated a percentage of the employer's premium. So every year when the health plan goes up, and they usually go up 10 to 30% every single year, the broker, when they come to 11 months later, they come talk to you about your renewal rate, what's going to happen next year. 100% of the time, it's bad news. We're going up another 15 or 20% this year. But they're getting a raise at the exact same time that they're delivering this bad news to the employer. So again, we need to make sure that whoever's advising, their incentives are aligned with the company's objectives. In addition to that compensation, there's also kickbacks, basically, that come from the carriers. Blue Cross, United, if you sell 5 more of Blue Cross plans this quarter, we'll send you to Hawaii. If you sell 1 more United Healthcare plan by the end of the year, we will give you a $5,000 bonus, right? And so all of that happens behind the scenes, behind the curtain. Those are things that people usually never talk about.
So where does DPC fit in this model? And the actual answer is it doesn't, right? Because one, employees are saying, well, I'm already paying for this insurance that I barely can afford or can't afford. I can't pay for your membership on top of that. Or I'm already paying for a plan that includes primary care. Why would I pay extra for this, right? Especially from the employer's perspective, this is a very huge expense. Under payroll or after payroll, this is the highest expense that an employer has. so they can't afford both. And if for whatever reason they may be able to, you're actually rewarding Blue Cross's bad behavior or United's because you're making them look good while the DPC is doing all the work and getting no credit. So it doesn't fit in that model. So now we're going to shift over to what you can introduce to an employer and really where it starts making sense for everybody involved. Self-funded health plans. And you kind of heard that throughout the conference, so we're going to go a little bit into the weeds of, well, what is a self-funded, what's needed, how does it work? Because again, you're communicating this to your employer, or if you're working with an advisor, you're going to want to at least understand where they're going with it, because again, you're the one that's typically going to bring this to the table. First part of a self-funded plan is how do they rate the premiums? We saw previously how it was done. With self-funded plans, there is some more extensive underwriting. If you're under 50 employees, there's usually health questionnaires involved. And one thing that I always educate employers on is every single one of your employees, for the most part, shows up to work every day, which means they're fairly healthy, right? And so you're going to get a favorable rate just by going through that process. What we've seen in the few years that we've done this, 15 to 25% less on premiums from the gate just by going through this process. Because again, everything is about risk. If now you're giving the insurance company the data that they can properly assess the risk, they're going to lower the rates because of that.
So the other thing that we have to help employers understand is this network that they're being sold, right, by all these hundreds of thousands of brokers all over the country. They're selling them the Blue Cross network, the United network. We have to help employers understand, is that network actually helping you or is it hurting you? And the way we do that is by helping them understand what happens behind the scenes in a network and how do insurance companies actually make money. So most of us think they charge us a monthly premium and they make their money off of that monthly premium. That's actually just the baseline starting point where they make money. The real place that they make money is through their networks. And they penalize us for going out of network. They make us think these doctors that are out of network are ridiculously expensive. So we're going to double your deductible if you go out of network, and that's just to keep you within the network so you don't get gouged by these crazy doctors. Basically, everybody in this room is out of network, and we are the most affordable and high-quality medical practices in the country. So we all know that that's not true, right? But if we go out of network, they cannot gouge us and the health plan. And that's the reason why they force us to use a network. So an example that many of you know is an MRI costs $300 to $500, the actual cost, right? But when you use your Blue Cross or United card, they bill $2,000 or $3,000 for that MRI. Blue Cross has pre-negotiated contracts with all these providers and facilities around the country, and we don't have any legal right to see what those contracts say. And none of those contracts are in our favor. But when we sign up for a Blue Cross or United plan, we're signing up for those pre-negotiated contracts, and we lose all of our negotiating power. And so when someone gets an MRI with that network-based plan, Blue Cross is still cutting a check to the imaging facility for $200 to $300, and then they're paying themselves the other $2,000, and they don't have to ask permission to do that because they're managing and administering the plan. So this is the reason why we need to remove the network, because now we have all the negotiating power, and we essentially are able to pay the true cost of what everything costs for every single thing in healthcare. So another important point that you want to help employers understand is employee education is extremely critical to the success of these types of plans, right? We're removing a network that everybody's used to and that all providers and facilities around the country recognize. And we're giving them a health insurance card that says their company's name on it, and it doesn't say Blue Cross's name on it because their company has designed the health plan, not Blue Cross. And so, you want to make sure you're working with an advisor that understands all of this, that heavily educates on DPC. They understand DPC. Hopefully they're a DPC patient themselves, right? Because we have to help these employees understand. Everybody in the country right now that says they have the best doctor that's not in DPC, they've basically found the best of the worst, right? And obviously I'm not calling doctors bad doctors. It's the system that's forcing them to practice a certain way, but they've found the best of the worst. And so they don't really know what they don't know. And so we have to help them see the light, and we have to educate them about DPC, and we have to make it their idea to want to join our DPC plan. And so we do that through very heavy education continually with the employees. And then we also do the same education around this removal of a network, right? So as an agency doing these types of plans, you have to be full service or, DPC-like, in that when we set up health plans and we educate employees, we do all the education about why DPC is so amazing, and that should be the first place you go for everything that you need. And then if the DPC refers you out of their office for something, make sure that we're the first phone call, text message, or email that you send to let us know that you want to go to Dr. Jones for cardiology or whatever other specialty, or ask us to help you find a specialist if you're being referred out. Because if you go and show your insurance card at this facility that says your company's name on it, most likely the person at the front desk is going to say, we've never heard of this insurance, we don't take it. And then the employee is going to be frustrated. They're not going to like us. They're not going to like our health plan. And so we are very upfront with employees when we do our education. We let them know we are basically, you have your DPC doctor and we're your DPC agency. So reach out to us when your DPC doctor tells you you need to go outside the office for something. We will get your first appointment taken care of as far as scheduling, so that the office understands how everything works with your insurance and you don't have any frustration. Everything goes smoothly. And then every time you have to go back, everything's good. They already know how everything works, and it goes smoothly.
So how do you get DPCs or employees to sign up for the DPC plan, right? A lot of times they've had a doctor for many years, or they're just used to what they're used to, and they don't want to choose it for whatever reason. Well, you want to incentivize them, right? And you've also heard that throughout the conference. You want to give them imaging, labs, generic medications. Doing this for as long as I have, the moment I finish an employee presentation, for the most part, that employee just forgot everything I just told them, right? Because they're at work and they're going to, perform their job. So you have to give them that incentive, so that's what they remember. Oh, the DPC plan is free. I get full access to the doctor. That's the one I'm going to try, right? So that's what you want to do to, again, steer the employees to the right plan. Because if you don't, the plan may suffer a little bit. The employer may say, well, we're not saving as much as I thought. Might as well go back to Blue Cross. But this way, they're going to not only see the value in DPC, but they're going to get a return on that investment. This is a very important part of a self-funded plan. Stop-loss insurance is what we call the real insurance behind a plan, because this is what's actually paying for all the catastrophic things that employees get insurance for. Surgeries, right? Hospital visits, expensive treatments, chemotherapy. That's what the stop-loss covers, and there's no limit to what the stop-loss will pay. So that protects the financial risk from the employee and the employer, so they know ahead of time what their risk is. And so there's never an opportunity where, oh, this cancer treatment ended up being $2 million, we're going to have to ask you for more money. Not going to happen if you have the right stop-loss. The other thing that happens in a self-funded plan, and I'll give you a visual on the next slide, is there's something called a claim fund. So part of the premiums are getting divided and paying for some of these smaller claims, right? With stop-loss, you want to set a threshold depending on the size of your company, 10,000, 50,000, 100,000, depending on what that is. So anything under that is paid by the separate bank account that we set up. And if that money ever runs out, let's say you have a lot of small claims, the stop-loss will also kick in. So you want to have those layers of protection for your employer. So again, there's no situation where they're financially at risk for something. This is a visual of that. Left-hand side, fully insured, right? I pay my premiums. I never see that money back. They don't tell me how it's spent. It's gone. On the right side, now you get to see some transparency, where the money is going, how it's being spent. So claims fund is one. Then we have the stop-loss premium. You're also going to want to find an independent TPA. Somebody has to administer all of this. You got to have vendors that are paying providers or physicians. So having an independent TPA will help. And then in regards to medication, you're going to want to have things like international sourcing, somebody that helps with manufacturer's assistance. All of these things are vendors that provide these services. So the TPA kind of just handles the coordination of all of that. That's just a visual. And of course, what does an employer want to see? They're changing entirely what they're doing. This is what they want to see. They want to see a return on their investment.
So how do we help the employer understand that the DPC membership is not only there to provide super high quality care to their employees and keep them very healthy, but it's also there to help them provide a return on this investment. We teach the employers when we educate them that DPC, again, it's not only getting your employees very healthy in a proactive, preventative way, but it's also protecting all of this money, right? So as Angel talked about on the last slide, basically you have a monthly premium. We build DPC into that monthly premium at a very, as high of a value proposition as possible. So usually around $100 a month. You want them, so you've got a monthly premium, and what's happening is about half of that monthly premium is going into this separate account that's paying for the small claims. The other half is going to pay for the stop loss insurance that has no limit, that's covering all the really bad things, the hospitalizations, the cancers, the major surgeries. And so this small claim fund, it's not technically small, especially if you're a larger company. If you've got 50 or 100 or 200 employees, it becomes a very large claim fund. And DPC Care handles about 80 to 90% of all the employees' needs in a very high quality way. And none of that hits the insurance plan or that small claims fund as claims, because those small claims are paid for by that small claims fund. So DPC is essentially steering all these unnecessary claims away from the health plan and protecting that small claims fund money from being used unnecessarily. But we do have it there to be used when it's necessary to use it. And so that's how we help the employer understand how they're getting a return on investment through their DPC. And because I'm so intimately involved in the DPC world, and I understand kind of what we want from a physician's perspective in DPC, when all these executives get together in a room and the benefits advisors and the executives are all kind of figuring out the plan and start cooking up crazy ideas about all this nonsensical reporting that we don't want to do, I'm able to shut those things down, right? Because we don't need them. And I'm able to advocate for the DPCs and make sure that we build the plan in a way that we don't have to do all the nonsensical things that really provide no value. All we need to do at a renewal meeting is show them two pieces of paper. One is a very detailed claims report that shows everything that happened through the insurance. The other one is a DPC usage report that gets spit out of most of your EMRs in 30 seconds, right? Just showing an anonymized way of how many text messages, emails, lab results, prescriptions, all those things. We show them those two pieces of paper. One shows almost no activity on the claims report usually in our groups. The other one shows all the activity in DPC. That's all the reporting we need to show them once a year, that you have no claims because everyone's using DPC. So that's kind of how we do things. And then you also want to help employers understand this is a long-term strategy, right? What employers are used to doing at renewals is what we like to call the healthcare dance in the traditional system. So as I mentioned previously, the health insurance costs in the traditional plans are going up usually 10 to 30% every single year. So when the broker comes to have the renewal meeting with the executive team and explains to them, we're going to get another 20% increase this year, usually everyone starts to panic. How are we going to afford this? How are our employees going to afford this? Let's just be reactive and start doing things that can lower the premium, like narrowing the network, going from a PPO to an HMO. All these things that are essentially reducing the quality of care and reducing the access to care for employees, just to try to save a few dollars on the premium. That's not a long-term strategy, right? And so we want to help employers understand this is a long-term strategy of self-funding without a network with direct primary care. We're going to look at this from a 3 to 5 year standpoint, and we're going to help show you after year one, we're now going to have a large amount of money in this claims fund that's going to roll over to year two, and you're going to start year two with tens of thousands, sometimes even hundreds of thousands of dollars in an account that it can be used for healthcare spending. Now, when we're starting with $50,000 or $100,000 in an account, the employer can do all the things that they've always wanted to do for their employees. They can start paying more for employees. They can start paying for employees' dependents. They can start including more services free to or no cost to the employee. They can also do things to help them become their own little insurance company with this large stop loss hanging around in the background, right? They can push up the stop loss limits, which is basically, you guys can think about it like a deductible, right? If you have a deductible on your auto insurance that's $500, you're going to pay a lot more every month. But if you push it up to $5,000, you're going to pay a lot less every month. So we do the same thing here. Once we know the utilization after year one, we can advise our clients that, hey, let's push the stop loss deductible from $50,000 to $75,000. That's going to bring our costs down. And we already have the money in the bank to fund any catastrophic things that happen that doesn't hit the stop loss limit. Yeah, go ahead.
So as these opportunities start coming to you, because you may have a patient that says, hey, I'm a business owner, I'm a CFO, how can we make all of this work out for my company, right? You're already hearing stories of that throughout the conference. Now as a DPC, you're in the driver's seat. You get to pick what advisor or broker you want to hire, right? So we're going to give you some tips on how to vet, questions to ask, because if you go to any advisor in your town and say, hey, I got a new group for you, do you want it? Everybody's going to say yes. But is it the right advisor for your group? A couple questions. How well do they understand DPC, right? Do they know it as well as you do? Are they a DPC patient themselves, right? Neer pointed that out. Think about it. If they're going to promote, sell, encourage DPC, and they've never tried it themselves, are they going to get high participation, right? Think about some of those things and ask them, right? It's basically like a job interview, right? If you're going to be my advisor for this group, what are we doing?
You also want to understand how much, where does their approach lie, or where does their strategy lie, right? Or how much fully insured business are they doing, basically? Which fully insured is kind of the traditional system we talked about, where there is no transparency around the money. You're just paying it. It's going into a black hole, and then you got to pay 20% more every year after that. So you want to understand from the advisor's book of business, are they doing those broken plans, and how much of their business is with those broken plans? And that will help you understand whether that's somebody that's going to be aligned with your objectives and helping do what's genuinely right for a company and for your practice. You also want to understand, is the advisor that you're working with, are they okay with the pricing that you're charging? Because these are your practices. You guys are the bosses. You call the shots, right? And you create the prices. And so are they okay with incorporating your prices into their employer's health plan? Or are they trying to ask you, will you take $50 for an adult, or will you take $30 for an adult? Are they trying to devalue what you're doing, right? As we mentioned in this presentation, the DPCs are doing the lion's share of the work in these health plans. And you guys know what you do, right? You do the lion's share of the work with any patient, whether it's an employer patient or not. You're the front lines. They're coming to you for everything. You're seeing them, you're evaluating them, and then you're kind of deciding what needs to happen from there and what the plan should be. So your work should never be devalued, and you want to make sure that advisors are not trying to do that.
How are they compensated, right? We saw on the traditional side, the higher the premiums, the more money they get, the more bonuses. How is their comp structured within your self-funded plan? Do they get paid more the more expensive they get? Where is that incentive? You really want to ask those questions. So again, you're in the driver's seat. You're picking them. That's what you want to understand. The last slide, this happens almost with any group. There's a learning curve. It's a very emotional process for a lot of companies. They start off with some denial, some anxiety, like, are we really leaving the network? I've had this for 20 years. This all my employees know. Are you absolutely sure this is the way to do it? Then as we start going through the process, and they say, okay, well, I like the DPC. I like what they're doing. Now they're starting to maybe accept it a little more. Then at the end of your renewal, when everybody's used it, they see the ease of it, how much money they save. Now they're enthusiastic. Their energy is there. They're going to start referring their families, their other employers, other owners that they know. But it's a ride. It's not going to be smooth sailing the whole time, but you want somebody who's committed to the process, and you want to encourage them every step of the way, that you're putting all the tools in place to protect their employees, and you're not just going to do what the other advisors do and just show up once a year and say, hey, thanks, we'll see you on the renewal. Again, you want an advisor that's helping every step of the way, so the employees know that, this person is actually listening to me. They're actually following through on a promise. That's something that I've learned in the insurance industry. Regardless of what policy I sell and what insurance company is on that policy, if I sold it to them, they're going to call me and say, no, you are the one that sold this. You got to fix this problem. So you want somebody that's following through on those promises.
Thanks so much, everyone.